welcome. I'm glad that you joined us again for another video. Boy, I tell you, that last one, Jan and I both worked on that. It's painful. What a topic, the journal entries for plant fund. We did edit after edit after edit, and we hope we got it basically right. Well, this next one is a little bit easier, and it's about depreciation. And so today's video is going to look at things like why we do depreciation, what's the difference between recording depreciation and funding depreciation, and what to do about partial years. It's a real short video. I think you'll enjoy it, and it will be a lot more fun than say the last one, and a lot quicker. So thanks for joining us, and stay tuned for our training on depreciation. Well, we're back in the accounting manual, working through some topics, maybe not trying to cover every one of them, but just the ones that seem to catch my interest of what might be interesting, or where people are a little bit confused or wrestling. This one's not too big of a topic, but it's just a little bit of fun things for us to cover. And so today's topic is depreciation. And so let's just go through the section here in the accounting manual on depreciation and hit some of the topics, the high points, and then we'll look at the financial statements on exactly how it appears and the way it's supposed to work. Okay, depreciation. We all pretty much have covered depreciation in our accounting training. It's at least the concept fairly well known around the world. It is interesting to know that in accounting, prior to the United States allowing depreciation to be recorded as a tax deduction, it actually wasn't even practiced in accounting. So the concept of depreciation is linked back to United States tax law. At least that's my understanding. At least that's the word going around in accounting historian circles. But in any case, it is a practice which involves spreading the cost of the asset over the life of the asset. Now, also according to my understanding, IFRS allows you to do a cost-based or appraisal every year and look at the difference in the appraisal. But the accounting manual has said, no, we are not going to do that. So we can have comparability between our financial statements. We all are going to use the same method, and that is a depreciated cost method of accounting for our fixed assets. And but it is basically the spreading of the cost of the asset over the years of its productive life, over the years that it is contributing to the ministry of the nonprofit, to our organization, and sort of to have a true cost of operating the nonprofit each year. We spread it over its life. And if you that have studied depreciation learn there's all kinds of accelerated methods and units of production method of depreciation. Well, in the church, we're going straight line. It's fairly common amongst all nonprofits anyway, so it's not a big jump to do it. But we basically just spread it evenly over its life. Now, the one of the interesting aspects of the accounting manual, as you can see it here, is that an organization, whether you're doing fund accounting or not, and there are organizations that do not have to do fund accounting, but whether you have a plant fund or not, depreciation should be distributed among the departments that are using the underlying assets. So if the Sabbath school department is using a projector, then the Sabbath school department should be charged with that according to the accounting manuals. It should be charged with that depreciation. While it probably is not all that big a deal, if you think about it, of course, that makes sense. We want to be able to come up with a total figure of the cost of, say, operating Sabbath school, or the total figure on evangelism. And if we're not charging the department, they're missing a major portion of their cost, the cost of running the equipment that are used in the department. Some places is insignificant, some places important. And of course, true in all aspects of accounting, we assume materiality. If it's immaterial, if the departments are using an immaterial amount of equipment, then of course it's immaterial. It wouldn't be required to assign it to the department. But we assume, and when we start training in accounting, that we are talking about material events. And so a department is, according to the accounting manual, supposed to be receiving the charge for the depreciation charged against that department. One problem arises when you start looking at the idea of charging a function for the depreciation, is the fear of double charging an allocated function for the purchase of an asset and also for the depreciation of the asset. For example, suppose someone gave $100,000 for evangelism, and that was then put into an allocated function, and then you turned around and bought evangelistic equipment, and then when you depreciated the evangelistic equipment, you started charging that allocated function for the depreciation. Then you've hit it twice, once when you bought it, and then once when you depreciated it. So you'd have to make sure that you're very careful about exactly that you're consistently and fairly hitting that allocated function with the purchase of the asset or with the depreciation of the asset, but not with both. There's a little bit of confusion in the difference between depreciation expense and depreciation funding. Depreciation expense is the entry you learned back in college, where we debit depreciation expense and credit accumulated depreciation. The point of that entry is to spread the cost of an asset systematically over the life of that asset. And the reason we're doing this is so we can match the expense to the period in which it's contributing to our operations. At least that's the reason in a nonprofit. And so we buy a piece of equipment for $100,000. It's going to last 3 years. It's not fair for this year's operations to look like they have cost us that $100,000. It's fair to spread that cost over the life while that $100,000 is contributing to our operations each year for the next 3 years. That's depreciation expense. It goes back to the concepts of matching and accrual accounting that you learned back in school. Depreciation funding is something that happens within the church. It is actually a nonprofit concept, but it is and something that all nonprofits should be doing, but that Seventh-day Adventist Church has brought it to a whole new level. Depreciation funding is simply taking the amount of money that equals the amount of your depreciation and setting it aside so you have this little pool of money available for replacing your assets, so when they are used up. Now let's think about this for a second. When I record depreciation expense, let's suppose I'm operating on a break-even basis. I have a balanced budget, including depreciation. Revenue is coming in a cash basis. We're getting the cash for the revenue. And all of my expenses is that cash going out. So a donation comes in, I get the cash. And when I pay salaries, the cash is going out. Well, the exception that's going on there is with depreciation, because depreciation in any year is not using up the cash that like the other expenses are doing. So let's just say an organization has 100,000 of fixed assets that are going to last for 3 years. Well, if they're operating on a balanced budget, over the 3 years, at the end of 3 years, they should have that $100,000 sitting as cash in the bank. In a sense, that depreciation has sort of produced cash for an amount of cash in the bank accounts equal to the amount of depreciation, because the depreciation entry is not using cash. So what the denominational policy is saying is that we need to, instead of that cash just sitting there in the bank and we accidentally using it up for some other purposes without us realizing what we've done, that we need to take that cash that equals the depreciation expense and basically convert the depreciation expense to be a cash type of expense by moving the cash out of the regular operating account into some other account and putting it into the plant fund and squirreling it away there as an allocated unexpended plant fund function, okay, so that we can have that money to replace those assets when they wear out. And I think that's an excellent purpose of this, okay? So the accounting manual, this manual requires all entities to establish an allocated net asset account equal to the resources of any that have been set aside for depreciation funding, okay? So this depreciation funding is going to move the money, if properly done, is that we're going to take money out of the operating account and put it in a separate account. That separate account is going to reside in our plant fund and be accounted for as an allocated function of the unexpended plant fund, okay, within the overall plant fund, okay? Sort of confusing, but it just squirrels that away. And it's basically a little bit of a savings to help us when it comes time to replacing the items that are wearing out. And you say, well, where is the money supposed to come from? Well, the money comes from, like I said, where the money comes from, operating on a balanced budget, including all of your revenue and all of your expenses balancing, but one of those expenses is depreciation, and that depreciation is not using up cash and should be available for you to squirrel away as funded depreciation. Okay, now we have in the accounting manual suggested depreciation rates. As we travel around the world, I've discovered more and more that the governments that we're operating under are stipulating depreciation rates, and so we have, of course, government rules will take precedence over the accounting manual. But here are some suggested depreciation rates to help with useful lives. Now, rational boots on the ground approach to this is that you have to use useful lives that are true for your region and your location. These are just guidelines as possible life rates. You have to look at what's happening in your region. So we have down here desktop and laptop computers lasting 3 to 5 years, but if your laptops are not lasting that long, you should use a shorter period of time, okay? We have dormitory furnishings lasting 5 to 10 years. Well, definitely, I know the dormitory I was involved with, 5 years would be about the max you could come up with. But at least so you have something to work with here with these different categories as suggested. One interesting topic is what to do about fractional years. And the main rule with fractional years is that you must be consistent. So you can start depreciation in the month you put the asset into service, okay, which is usually the month you buy it, okay, but it could not possibly that it's not true. You know, you buy a car and the car is sitting there and it takes 3 months to get the license for the car. Well, you'd start depreciating it when you got the license. That's when the useful life starts. It's not useful sitting there in the parking lot waiting for the license to get in. But in any case, usually lots of organizations will start depreciating in the month that they acquire it, and they will stop depreciating in the month they dispose of it. But you don't have to. a very common convention is to not depreciate it in the year you buy it and depreciate it for a full year. Okay, very common for that to happen. Not you can do all sorts of things. Not to depreciate it in the month you bought it, and depreciate it a full month in the month you sell it. Any consistently applied practice is just fine. Now, just taking a little peek before we leave, before we leave this topic of depreciation at the financial statements, let's just make sure that we are all in agreement with have clear understanding about depreciation. In the plant fund, here's our plant fund income statement. In general, the only expense that appears in the plant fund is the depreciation. So in this example here, our sample financial statements of $180,009 is depreciation. The only expenses that are allowed in the plant fund, just to get you, for you that like to have every detail covered, is depreciation expense is allowed in the plant fund, and any expense that is connected to investments in the plant fund. So if you had investments like stockbroker fees or management fees for your investments, then that would be also a fair expense of the plant fund. But other than that, no expenses in the plant fund. So for example, repair expense and insurance expense and licensing expense and all of these sorts of things are not expenses of the plant fund. We can move down into the notes, and we can look at the depreciation note. And it is very important to keep in mind, whether you're using our standard financial statements or you're making your own, that GAAP requires that you disclose the amount of depreciation expense that has been charged in any year. And you can see here is this year and last year's depreciation expense. So there's the 180,009 that I showed you a few minutes ago. And that's pretty much wraps up our topic of depreciation. I appreciate you listening. Our next video, I believe, unless I get sidetracked, is going to look at all of these footnotes as a whole and what are the footnotes that are required in a set of financial statements that are done according to the accounting manual. So thank you for listening, and we will see you next time.